Very happy to introduce our next panel, Financial Firm Focus, the SEC's enforcement priorities for asset managers, broker-dealers, private funds, and hedge funds. Our moderator is Kristin Snyder, who is a partner at Debevoise after a very nice career at the SEC, where her last role was Deputy Director of the Division of Examinations, resident in the San Francisco Regional Office. Nice to see you, Kristin. Welcome. Our SEC panelist, second from the end there, is Sarah Nilson, Assistant Director in the Asset Management Unit, resident here in the Los Angeles Regional Office. And then rounding things out with a variety of perspectives, Hardy Callcott, partner at Sidley Austin. Hardy's worked in a number of roles in the securities space since his time in the SEC as Assistant General Counsel for Market Regulation, including time in industry at Charles Schwab and then in private practice. Emily Culbertson, there in the middle, Executive Director within Morgan Stanley's Legal and Compliance Division, based in Los Angeles. Prior to Morgan Stanley, Emily was a trial attorney within the DOJ's fraud section. And then Charles Lundelius, Managing Director at BRG and a leading expert witness, having testified, and this jumped out of the bio at me, in over 70 different cases. Kristin, turn it over to you.
Thanks so much, Peter. So we are going to dive right in because I think we're the only regulated entity panel on the agenda today. And so we're covering basically the waterfront. And we are very compliant. We were here right on time. And so we're planning to end right on time. But I think this panel looked and felt very, very different last year because we were very private funds focused. I think it was sort of private funds all the time at the SEC, whether it was rulemaking or enforcement or examinations. Now we're seeing a shift because we've left the Gensler era. We're now in the Paul Atkins era. And so I think we're expecting to see a shift back to retail-focused priorities, which we saw in Trump 1.0, although we'll hear from Sarah, I think, who has the latest and greatest, at least on current exam and enforcement priorities. But with that, I think we'll dive right in, because I know a new administration can kind of usher in different priorities. The exam program actually published priorities for 2025 back in October before the election. And so we're just all dying to know, Sarah, has that changed, or what are the current exam priorities?
Yeah, so the exam priorities have not changed. The 2025 priorities are still current, and that is what exams is continuing to apply in their daily work. As I think most of you know, the priorities represent areas of potential risk to investors in the market where exams has decided to focus in its examinations, and I'll highlight just a few of those. So for investment advisors, as in prior years, exams is focused on whether advisors are fulfilling their fiduciary duties to clients, and they're looking both at the duty of loyalty, whether conflicts are disclosed, mitigated, or eliminated, and they're also looking at the duty of care, whether advisors are acting in the best interests of their clients. Exams is continuing to assess investment advice, recommendations, and disclosures made to clients, and they continue to evaluate whether investment advisors are adhering to the compliance rule. One of the new priorities for 2025 is higher risk products or strategies, and that includes higher cost products, unconventional instruments, illiquid and difficult to value assets, and higher cost products, and assets sensitive to higher interest rates or changing market conditions. So for private funds, those are of course still in the 2025 priorities, and their exams is really focused on disclosures, allocations of fees and expenses, and compliance with recently amended Rule PF, which enhances the reporting requirements for private funds. And they're also looking at policies and procedures related to the marketing rule. Registered investment companies are also a continued focus, as these are popular products among retail investors and elderly investors. And so you can see exams looking at registered investment companies' compliance programs, disclosures, and governance practices. And for broker-dealers, exams is evaluating recommendations and disclosure practices to ensure that they comply with Reg BI. Also for broker-dealers and registered investment companies that are subject to AML rules, that is also a focus, looking to see whether they are complying with those rules. And a priority that crosses all registrant groups is emerging financial technologies. And this includes things like the use of automated investment tools, artificial intelligence, and trading algorithms or platforms. And I'll just end by noting that I'm in enforcement. Enforcement does not publish its own priorities, but these exam priorities do inform enforcement actions, both because they represent areas that are important to the commission, but also because exam referrals are an important source of cases for us.
That's a ton to unpack. Thank you, Sarah. And maybe we could just step back quickly. I think before we get into a lot of the substance of the areas that you've highlighted, we've heard, and there will be a later panel that I think will talk in more detail about some of the changes that have happened just in terms of structuring in the Division of Enforcement, as well as across the regional offices. But it would be helpful just, given where you sit in the asset management unit, we've seen some kind of staff depart the agency in various regions, and we've just been watching from the outside as we see a number of departures. Has that changed the structure of the asset management unit? What's that going to look like? And then also just with the regional exam programs, has that changed?
Yeah, so I know the reorg has been addressed some today, and it will be addressed more, I think. But I'll just touch briefly on how it's affected AMU and the regional exams programs, which there really isn't that much impact. The only structural change that's impacting the asset management unit is that we now report up through a new deputy director who's overseeing all the units, and that is Jason Burt. Corey Schuster is still the chief of our unit, and we still have staff in the home office as well as in 9 regional offices. That includes attorneys, industry experts, and paralegals. And then just to briefly touch on the regional exam programs, the only change there is that the exam programs in the regional offices are now reporting up through the national program in the home office rather than first through a regional director in the respective offices.
That's helpful. And just I would throw the question open to my co-panelists. With the reorg, even though it's not been a very long time, are you feeling or seeing anything different? And anything that you think would be sort of a practical tip or takeaway as you're working on enforcement matters or exams?
Yeah, so let me start on that. So I think we do have to recognize, Paul Atkins has only been at the SEC now for maybe 3 weeks, and he has not yet hired the heads of the different divisions. Most of the divisions still have acting heads, who had been at the divisions, in the prior administration. So those people are going to come on, and they will have priorities of their own, presumably coming from Chairman Atkins, and we just haven't seen a lot of that happen yet. I will say, I think a lot of us have observed there has been a lot of turnover at the SEC. It's not as great as some other agencies, but it is particularly focused in sort of senior people who had a lot of the long-standing institutional knowledge at the SEC, and so it's a little bit of a concern from the outside that some of if there is some kind of financial crisis, people who have dealt with financial crises in the past, a lot of those people have taken buyouts in the last couple of months. So have there been some changes? Sure. There are some areas, of enforcement inquiries that have been dropped. We'll talk, I think, about
crypto.
We already talked about crypto, off-channel communications. I think we're going to talk about some of the bank sweep investigations. I mean, there have been a lot of, and I think there's been generally an effort at enforcement to close old investigations that weren't really active. I've had more closing letters in the last 4 months than any time in my career. But the basic blocking and tackling of we're against fraud, especially on retail investors, that's going strong and not changing at all.
Yeah, no, that's a good point, Hardy. And I think on the exam front, and even with our asset management clients who are undergoing exams, it's sort of regular way, and we're not seeing a huge difference as of yet. That has not trickled down. And so with the private funds priorities, we're still seeing same fee and expense areas, conflict areas that are top of mind, same request list, same kind of asks, and digging into all the same areas that existed pre this administration. So it'll be interesting to see how it unfolds. I know that some of the other panels have talked some about data and technology. You touched on emerging technology as being an exam priority, and I think we've seen that kind of perennially. In enforcement, certainly, there's been a lot of talk about artificial intelligence and roundtables and a focus at the commission level. We've also seen, I think, information sweeps that have gone out even past administration and now even the current administration, seeking information sometimes just on data use cases. Sometimes those can be vague and not necessarily understanding the point. And I think, Emily, you may have a perspective on kind of what you're seeing just from an in-house lens.
Yeah, I think as Hardy was alluding to, I think the core function that you see from the SEC of rooting out fraud, misconduct, or misappropriation from retail investors is still very strong, and I think those investigations can be more focused. They know exactly what they're looking for, what individuals or conduct they're looking at. But I've also seen a sort of developing practice where there are informational requests coming out from the SEC to financial firms, asking questions, I think particularly maybe driven by some emerging technologies about what are firms doing, asking for descriptions of like processes or different ways that they might be doing business. And sometimes those requests, because they're not targeted to a particular conduct or accounts or an individual, they can be a little bit hard to get traction on and understand exactly what they're looking for. And it's challenging to answer the questions if you're just wondering the whole time, did we do something wrong? Is there something we're looking for? And wanting some of that direction. But I think as we've seen these play out, I think there are instances where they're really just looking for information about how the industry is evolving. And I think that in responding to those, one thing that has been pretty effective that we've done is just engaging in a conversation with the SEC attorneys about trying to get a better handle on what exactly their concerns might be, and starting maybe with some low-hanging fruit in a production of like, here are policies and procedures on that, and then if there are other questions or descriptions of processes that they want, kind of having phone conversations about it and later coming to the written responses so that you're not trying to describe your entire program inside of your business.
Yeah, I'll just follow up to say, we've had clients get requests recently from the TCP, the Technology Controls Program group at SEC exams, which historically was focused on sort of exchanges and clearing agencies, very highly regulated entities. They're now going out to sort of ordinary broker-dealers and investment advisors and asking questions about things like, are you using AI? And, and what use cases are you using for? And what vendors are you using? I think there's a interest, and FINRA's has this interest as well. Are there vendors who are not regulated entities, but that a lot of regulated entities are using? So there's a sort of dependency that could affect, create systemic risks across the industry. That's something that the SEC and FINRA both want to understand better. So it is focused on emerging technologies and especially, sort of data, customer data, use of customer data, flows of data.
Yeah, and the TCP group it's kind of one group within exams, and it's made up of chief information security officers, people who have kind of that cyber tech knowledge. And it kind of makes sense, I think, with the acting director of exams being a person who came from that group and with that background, that it's kind of permeating into the core areas of exams. And I think just with so many of we had the telemessage hack that happened, just in the last couple of weeks. I think there were so many well-publicized cyber events, even during the pandemic, that it really drove additional staffing to that group. And I think they're, kind of permeating through the exam program and then working with the enforcement cyber unit. Yeah, no, it's interesting. And I wonder, are there things, I think you gave really good tips, Emily, just in terms of ways in which, you might be able, especially at a large organization, be able to educate the exam program because they're coming in, they don't necessarily know how your organization works. But there can be a challenge, I think, at being at a larger organization too, and just sort of getting the right pieces and the right pieces of information kind of collectively, to respond to those types of requests. And what's worked well for you there?
Right. So just as a little bit of background, I work for the broker-dealer side of Morgan Stanley. It's just an enormous organization with many other lawyers. And just to be clear, I don't know everything that goes on at Morgan Stanley, and I can't speak for all of Morgan Stanley. But I can say from my own experience that when you have a request that might touch a number of different business lines and it's a little bit undefined, one of the things that I've found really helpful is to bring in outside counsel to have a smaller group of people with a more high-level view of the firm to just brainstorm of different ways that different teams you might interact with or different ways you might get at the information that the regulator might be looking for. So for me, inside of Morgan Stanley, that's really helpful with our legal advisory coverage. So I do litigation and regulatory matters, but there are also lawyers who cover, our stock plan business or digital direct channel or different kind of channels we have in the business. And it can be really helpful to have those in-house attorneys be able to give a high-level overview initially to really begin to understand where you might want to go deeper.
And it's a good point. I think the other thing that maybe we've seen as a trend, and we were chatting about this before the panel, is just the expectation from regulators, especially at a well-resourced place, if they're coming in to do an investigation or an exam, that you have technology at your fingertips, to help you pull the information together. And that could be in responding to a request, but it also could be prior to, that request coming in, and are you ferreting out any issues, that you should be on top of, maybe in their view. Because you do have access to resources and tools. And so, I don't know, Charles, Hardy, Emily, I'll throw it up into the whole group, but just, in terms of maybe what you're seeing in the marketplace along those lines, if you see those kinds of regulatory expectations, we're definitely seeing them. And then, sort of the best ways to handle, or any tips there.
I would say just what I'm seeing is a concern about disclosure of confidential information through use of AI, which means that essentially you have to have some type of technology ring fence around whatever you're using. So our firm has taken that precaution. I think that's always a consideration. Is you could have some financial advisor go on and ask a question in AI, but in the context of doing so, disclose something that shouldn't be disclosed. So those are certainly concerns that our firm is looking at, and I think other firms would too.
Yeah, I'll add that I think in the AML area in particular, there's an increasing regulatory expectation that you're going to use technology to help you not just do your initial customer identification program, but your ongoing suspicious activity monitoring, and those expectations rise sort of every year. And as you guys know, FinCEN has adopted a AML rule that becomes effective beginning of next year for investment advisors. And I have to say, I have a sort of general view that there are a lot of people in the investment advisor industry that don't understand yet what is coming for them, because those regulatory expectations are very high. And it's not an easy or quick build necessarily to get to the place that regulators expect firms to be at.
Yeah, I would say that I've seen that as well over time. Like I said, the core SEC function of wanting to root out fraud, misconduct, and all of that, as technology is emerging and evolving within firms and more data is available, I think they're expecting firms to step up along with that evolution to be really on top of potential red flags or data analysis that can help them identify bad actors, not just their own employees, but external bad actors that might be acting on their platform or on their clients externally. So I think that is one of the things that's kind of increasing as our technology is better. I think that on the other hand, there is some kind of concern or interest in ways that a firm might use data in other ways. So I think, a huge firm like Morgan Stanley, we do have a lot of data, client data, that we've always seen, like Reg SP is a priority to keep client data private and to safeguard it, and that's a very big responsibility. But you're also, they want to know, regulators are starting to ask, like, how are you using this data internally, or are you monetizing it to sell it in some way? How you could maybe look at it, I look at it as like an analogy where in the news recently there's been a lot of interest in social media or other tech companies getting data and using that to market or to monetize it, sell it. And so I think there is some interest by the regulators in our firms doing that. And how are they using this data in more of a business sense as well? And I think that's some of the interest that we've seen.
We saw that with some of the alternative data sweeps that the exam program did a few years back, where they were looking to see, sometimes it was buying, kind of non-traditional data from outside parties, but for larger firms like you're talking about, it could be those firms kind of using the information that they take in to then sell those data sets to other folks. So I imagine that, to your point, we'll see more of that.
I think it's important, from the way I'm thinking about it, is making sure that these questions are being asked internally. What is happening to our client data internally, and who has access to it? Why do they have access to it? How are they using it? I mean, these are just things to be aware of as legal counsel inside of the firm, and make sure that the right questions are being asked and you're being intentional and deliberate about that.
Great. Well, we'll pivot, I think, back to you, Sarah. And you kicked us off talking about exam priorities. And I know you noted that there are some common threads with priorities for the asset management unit, but it would be helpful just to get a lay of the land and, what the current priorities are for AMU.
Yeah, so I'll note, like many other of my SEC colleagues have today, we're only a few weeks into Chairman Atkins' tenure. We've seen some shifts in some areas, and we'll likely see more. We'll just need to give this new commission time to speak for itself. But in the asset management space, we have continued to bring cases in core areas over the last several months, and that includes, of course, fraudulent conduct, misreps and omissions, and breaches of fiduciary duties, among other areas. And we brought these cases against investment advisory firms, advisors to registered investment companies, and advisors to private funds. And I'll just highlight a couple of recent fraud cases, and both of these are litigating, so I'll just give a high level from what is alleged in the complaint. But in March, we filed a litigated action against an investment advisory firm, Upright Financial, and its principal for operating a mutual fund in contravention of its concentration policy. And the policy there said that no more than 25% of the fund's assets should be in any particular industry. And according to the complaint, the advisor breached its fiduciary duties and engaged in fraud when it invested more than 25% in a single security, and then also in a single industry as well. And in December, we filed a litigated fraud action against Kenneth Leach, a former chief investment officer at Western Management, for an extensive cherry picking scheme. And according to the complaint in that matter, Leach, who was a portfolio manager for a number of Western Assets investment strategies, allocated trades of more than $600 million in first day gains to certain favored portfolios, and allocated trades with more than $600 million in first day losses to certain disfavored portfolios. So those are just a couple recent cases, and note that in both of those we did charge individuals, which is of course something that we will continue to try to do where we can.
Yeah, that's interesting. And I know you probably can't comment on this, Sarah, so I won't ask you, but I'm just thinking in the Western Asset Management, or the Western Management case with Ken Leach, that's an interesting area, just in terms of cherry picking, where I think, again, we're talking about technology and firms being expected to kind of review their trading or other sort of red flags that they might be seeing. And so I would expect we may see increased expectations from the SEC in areas like that, dispersion testing that takes place there after trades are made, to look back and see whether things are being allocated fairly. So Hardy, I know there's a case that that we talked about as a group, the One Oak case that I think Sarah was also going to highlight for us, but I think a perennial area really in the retail space has been on kind of dual-hatted firms that have both a broker-dealer and an advisor program, and with Reg BI, with fiduciary interpretation, I think, and especially coming into this kind of an environment where we're likely to see more retail cases, I think it's top of mind for a lot of folks too, and especially also as other firms, maybe even in the private fund space, are thinking about getting into the registered fund world and just more access to capital and having those considerations top of mind.
Yeah. So on the broker-dealer side, we've got Reg BI. On the investment advisor side, we've got the investment advisor fiduciary interpretation. They were both adopted on the same day back in 2019, and so they're very parallel, and the SEC has issued a number of sets of FAQs about some of the concepts like duty of care and conflicts disclosure, where they've applied those FAQs to both the broker-dealer and the investment advisor side and said that the duties are very similar. And I think we're seeing, for the first few years after those were adopted, many of the cases were against firms that just hadn't adopted policies and procedures at all, or they'd adopted things that were completely generic and weren't tailored to their business. Now I think we're starting to see much more specific cases about specific types of products, particularly complex products. And so alternative investments are a great example of that, where the reps and the firms didn't really understand the products that they were recommending to people. Another area, and the One Oak case is a good example of this, is account type recommendations. Are you advising someone to go into an advisory account versus a brokerage account, or then moving assets from one kind of account to another? So anyway, we're getting a lot more specific guidance, both from FINRA on the Reg BI side and the SEC on the sort of investment advisor fiduciary side. And so I do anticipate that over the next 4 years, we may see a little bit less focus from the SEC on sort of the internal operations of the private funds, but sale of private funds to individual investors, even high net worth individual investors. I think that is going to be very much a priority, and we're definitely seeing that. And again, on the FINRA side, they've said, in their priorities for this year, registered index-linked annuities is an area that they're very interested in, because again, it's a complex product that they think that firms and reps don't necessarily fully understand. So I think that's going to be an area that we see a further focus on, both in investigations and in exams.
Charles just reminded me that I didn't give my disclaimer, so let me go ahead and give that.
Oh, I thought that was a blanket one for everybody at the SEC, but no, we're
yeah. So my comments are in my official capacity as an assistant director at the SEC and do not necessarily reflect the views of the commission, the commissioners, or other staff members. And just going back to what Hardy was talking about a minute ago, I just want to point out that in the One Oak case, I think the order contains just a very interesting reminder about how broad an advisor's fiduciary duties are, and that they really apply to all investment advice that party is providing, and also a reminder that advisors do have a duty to monitor and make sure that the advice that they're giving continues to be in the best interests of the clients.
So we'll just pivot for a second, Charles, because I was hoping to talk with you a bit about just a perennial topic, and it crosses lines. But it can be particularly pertinent and kind of at issue really with private fund managers, and that's the area of valuation. And I know you spend a lot of time, advising your clients, sort of on best practices and around governance and process. And that's an area where, again, like with the private funds, both the investigations and enforcement, as well as exams, that still continues to be an area of focus because it can flow into things like fees and expenses and the like. So maybe give us the lay of the land, what you're seeing and just good tips and advice that you would offer to asset management clients.
Virtually every SEC complaint against an advisor with regard to valuation will say the values of the assets are inflated, therefore that inflated or expanded your management fees. And so that seems to be the approach, or one of the approaches that are used on the enforcement side. I can say that what we've seen in terms of how these cases arise, they typically come up from my experience. Sarah may have a different perspective, but from my experience, these cases arise from investors that are complaining about something, or there is some exam that uncovered something. And the something that I've seen, at least in my cases, is a type of smoking gun memo that says someone in the organization doesn't believe a value that they put on this or that asset is right. And so I think the takeaway that I have after seeing several of these cases is that if you can have a process internally within your firm that is surfacing these issues, it's perfectly okay to have debate. Everybody likes that. And if you've got a concern about a valuation that's put on something, then that person that's making that comment needs to go and make that comment clear to the compliance people or the valuation committee or both, and get the issue resolved. The problems that I've seen in the cases that I've worked on is that smoking gun question just was left unanswered. It was hanging out there. And so if you have a process that brings this to resolution, that's tremendously helpful, I think, from a perspective of trying to anticipate any problems if a regulator comes across that same email. And then in terms of what investors are looking for, the investor side, they're looking for transparency. So what we're focusing on in terms of advice is to for investment advisors, of course, to pay attention to related party transactions, related party issues. This comes out in the private fund area a lot because the advisor or general partner may have an interest in one of the portfolio companies, for instance. All of these need to be surfaced and clearly set out. And if you want to know why transparency is important, go and look at the website for the Institutional Limited Partners Association. That's like the first word that you're going to encounter. The second word after that's governance. So that's what the limited partner investors are looking at. So on the one hand, I think you can take some preventative measures by making sure that everybody is on board with how you resolve questions about value. And then on the other side, transparency will hopefully improve the valuation process that the LPs are seeing, and they may not get to see all of the assets, and I guess that's that's an issue as to whether or not the fund is going to be that open and transparent. But if they at least have faith and confidence in the process, that addresses a lot of issues that are raised by the ILPA, as well as the issues that other organizations, such as the Alternative Investment Management Association, they all are looking at these processes. So that's an important thing to keep in mind.
Yeah, and you raise a good point. I think the email that you talked about, I think if you have a process, that's great. If you're following that process, that's even better. But you want to take care because everything is looked at with the benefit of hindsight. And so if something goes very, very wrong with a particular asset, and those emails or documents around, the asset, something going wrong with the asset are pulled, there can be a lot of second guessing, and we've seen it in exams and enforcement matters where they do have the benefit of a full record where they're looking back and looking maybe even at a snapshot in time where people are expressing skepticism maybe about that investment. And so those emails and those documents can really become kind of regulatory gold in ways that I think weren't intended. And so what do you think are sort of best practices that you've seen for your clients to protect themselves, to kind of document their decision-making process?
The best documentation is contemporaneous documentation. Please stay on your clients to get the documentation done at that time. A valuation is done as of a valuation date, and as time passes, the information that was known or knowable as of that valuation date will change. And it could be that you, say, have an oil field that's been valued on your balance sheet, and later it turns out that a bunch of wells are turning up dry. But as of that valuation date, the information that was known or knowable is what's critical. And if you have documented that contemporaneously, then that helps tremendously. It also helps with regard to data. I've encountered cases where we've needed information about various option transactions that were entered into, and yet options data after a certain period of time are very hard to get a hold of. So if you have, say, traders looking at a screen, and that's what they're using to assess in terms of the valuations, then you certainly need them to download that and save it, archive it, because that is critical as well. Another best practice is to get your valuation committee involved in the portfolio management process. The committee should consist of some independent people, if not entirely independent, and these would be individuals whose perhaps compensation is not directly driven by the assets under management, if at all possible. But what they need to be doing is talking to the portfolio managers to find out ahead of time what types of assets, particularly the exotic type of investments or any type of alternative investment, what type of assets they're going to be moving into, so that the valuation committee can start aggregating the amount of information that's needed to assess the propriety of the values that will be placed. And they may need to invest in new systems as well. The valuation committee should be talking with portfolio managers. Portfolio managers should be talking to compliance, because compliance has to know whether or not these exotic investments are within the remit of their mandate that's set out in the offering materials. And so all of this needs to take place. And and I guess the moral of the story is, don't lock your evaluation committee away in a conference room far off in a corner. They need to be out and interacting with the fund managers.
Let me just quick follow-up. Kristin talked about the smoking gun emails about valuation. The thing that worries me, I have so many of my clients who want to use these AI meeting summary tools, and they can be fine. I'm not telling people they shouldn't use them, but you should absolutely have somebody who is reading those summaries and is responsible for editing them, because sometimes the summaries are wrong. But what I worry about at least as much is there's going to be something that's a red flag that is in one of those meetings, and it's not tied out at that meeting. Right. And it could be on valuation, it could be due diligence on a private placement, it could be any number of different issues. But if you're going to have those, you need to have a process then for going and tying out and documenting how you dealt with red flags that were discussed in that meeting. So.
And if you're prolific in using those kinds of tools, at least if you don't have the bandwidth or the ability to review each and every summary, at least putting a standard disclaimer on the bottom of those summaries saying these are not reviewed for accuracy. I mean, at least it's something, and kind of.
But I predict that the red flag of the future is going to be the AI meeting summary as opposed to the email, or at least it will be.
Sarah's on the panel. Sarah, do you want to talk about emerging technology cases?
Yeah, I mean, I'll just talk a little bit about kind of how we're viewing these cases, and really we're viewing them in the same way that we think about other matters. And some of those things are, we're looking at whether there's false or exaggerated statements about the technology or the way it's being used. We're looking at whether the information is material to investors. Are conflicts disclosed or eliminated? Are advisors acting in the best interest of their clients? And are there appropriate controls and reasonably designed policies and procedures in place? We've had a number of settlements with investment advisors who've misrepresented their use of artificial intelligence. And I won't go into those cases, but Global Predictions, Delphia, Remar, those are fairly obvious situations, fairly straightforward situations of AI washing. But I'll talk just about an older case that gives, I think, a little bit more insight into how we've been thinking about these cases. And that's the 2023 settlement with Betterment, who's a robo-advisor that claimed to provide automated tax loss harvesting. And, according to the order in that matter, in disclosing its tax loss harvesting strategies, Betterment represented that it was scanning clients' accounts every day to determine whether the sale of an ETF could create a tax benefit, and if so, then it would replace it out with a correlated correlated ETF. But even though it represented that it was scanning accounts every day, it was really doing so every other day. And then they also didn't disclose a programming constraint that created potential lost tax benefits for clients when those clients used both Betterment strategies and a third-party managed strategy. And then the order also details 2 coding errors that prevented the tax loss harvesting system from scanning certain accounts. And the way Betterment responded when it discovered those errors is really important here. So when they discovered the first error, they told affected clients that they may have been impacted, but they didn't disclose the full scope of the impact. And then on the second error, which was discovered by a client inquiry, they didn't tell the rest of the affected clients. So I think the takeaway here is really that regardless of the technology that you're using, it's important to fully and fairly disclose what your technology does, the basic principle of say what you do and do what you say. If you say you're going to use AI to perform automated trading or do tax loss harvesting on a daily basis, then you need to do that and really understand your technology, know its risks and limits, and disclose those. And of course, adopt reasonably designed policies and procedures.
Thanks, Sarah. Hardy, do you have any takeaways from those cases too?
I think what we have generally heard from the regulators is that most of the rules that they've adopted are technology neutral. And so when you're thinking about AI, you think about the same things that you do for other kinds of technologies. How do you retain communications? How do you supervise communications? How do you produce communications, in connection with exams or enforcement inquiries? FINRA has asked, and FINRA's asked actually in a number of recent releases for potential regulatory reform ideas, and they've asked about AI and chatbots and the meeting summary tools and interactive websites. Is there some regulatory change that should happen there? I do think there are some industry trade group efforts to go back to the SEC and ask for some books and records reforms after some of the off-channel communications cases. So that may be something that we see in the next few years. I think the current SEC commissioners may be more open to that than maybe the last group of SEC commissioners were, but I do think there's some possibility of reform there that could be of interest to a lot of people in the industry.
Thank you. I know, and we covered a lot. I think we have just a few seconds left, but maybe just some last takeaways. And We were going to cover Reg BI. It's a huge topic. So I don't know, Hardy, if you want to kick us off with the last takeaways.
Yeah, well, I think I fully expect for the next 4 years there's going to be a lot of focus on, as we talked about at the beginning, protection of retail investors. And so on the broker-dealer side, that's most, in significant part Reg BI. On the investment advisor side, it is, the fiduciary interpretation. And, we definitely have seen more complex products, what people call sometimes the retailization of alternative investments, pushing those alternative investments to, individual investors, whether they're accredited investors or qualified purchasers. I think there's going to be a lot of focus in that area, and there should be.
Well, thank you so much to all the panelists. Really, really appreciate it. Thanks,
right.
Peter, for getting the hook.
Great job. Yeah.